The Nifty and Sensex have recovered from their losing streak, and the global markets are picking up on the ebbing of the recession fears of the US, with Goldman Sachs lowering the probability of the US recession by 20%. What is driving the Indian market space? What are the coming months going to probably look like for Indian markets? We have with us Mr. Samir Arora, founder and Group CIO and Fund Manager of Helios Strategic Fund. Mr. Arora, welcome to Republic Business. There has been never a better time to be an investor in India, or so they say. But you, given your long journey and a long career as an investor, does the Indian market excite you? That's my first question.
Oh, definitely does. And actually, I took a big bet in the 90s. I used to live in US and I said that India looks good and I got a chance to get into the market. So just give you a big picture that for the last 25, 30 years, Indian market is actually the number one performing market in the world in dollar terms. So India is looking exciting now, but generally India as a market has done well even in the past. And if you look at it over the last 5 years and 10 years and 15 years and 20 years and 25 years, in all these periods, India has done very well and mostly number one, except in the last few years, US has done better than India, but India has done well for long. So therefore, it is not a surprise that it is doing well now with both bottom-up reasons and good sort of policies and new interest in India from the world.
So over the years, as you just said, that there has been a lot of volatility in the market. Sometimes the markets have been doing extremely well. Sometimes it has been correcting itself. So as an investor, somebody who's viewing this program right now, what are a couple of tips to remain calm and calculated while taking market decisions?
So first thing is to understand that normally in the long run, equity markets do very well compared to other asset classes. And this is not just an India story. There is a lot of data on this, which you can find on the net, that in any country, the equity market returns compared to the fixed income government bond kind of returns, the average difference between these two is 5% per annum. And you can see this data for 100 years for some markets where 100 years data is available. And it works across markets and across longer periods like 10, 15 years. The only issue is that this return does not come smoothly. Never will you actually get 5% more. Either you'll get 20% more or 15% less, which means either you'll be plus 30, the next year will be minus 20 and so on and so forth. But over longer periods, it comes to being 5% or so higher. And this number is called equity risk premium. So the only thing to understand in equity markets is that in bad days, do not panic. You may stop putting new money, you may change your stocks, you may change your fund manager, but broadly understand that over time equities will do better. So once you accept that, and if you don't accept it from me, please go and search on Google for equity risk premium across countries, across periods. It always works out, broadly speaking, like that. And therefore, we say that the only thing to understand is that on bad days, you may not add, you may be nervous, you may even take out 5% if you are becoming too nervous, but broadly understand that over time, equity will beat everything else.
As you just said, over the long term, the market always plays out to be of benefit. And Mr. Arora, over the years, you have had some very strong positions when it comes to certain sectors. What do you think are going to be the winning sectors for the Indian market players in the long term? And also if you could give us an insight into the global markets for that matter.
So first of all, if you look at big picture, there are three sectors which drive the world. These are for like 70-80% of the money. And this is not only in India, this would be true worldwide. This will be financial sector, consumer sector and tech sector. And how to know that this is true again? Look at the Forbes billionaires list and say, because they tell you the billionaire country and sector from, or if you look at US, the sector from which they have come. They will broadly find only these three the sectors. Of course, consumer may be, divided into retail and consumer and media, but I'm saying broadly speaking, the consumer sector. So even for India, it will be this case that your three big themes for a large part of your money will be in consumer sector, financial sector, IT sector. And then every now and then, based on some government policy, some global issue, some local story, you will say, oh, I like defense and I like commodities or I like. But those are never going to be 20-year stories. The 20-year stories will be these three sectors, big picture. Of course, once in a while, you may find something from there. So we are always in these three themes by this design. But in our past, we have always been overweight financial sector. And that is because in the past, that is prior to this recent bull run, the private sector banks and the private sector NBFC and all did very, very well, like Bajaj Finance and HDFC Bank and all these. In recent days, these banks haven't done as well, the private sector banks. But the other financial intermediaries and all have done very well, brokers and exchanges and demat, this thing, or all these. So overall, we still always like financial sector as number one, consumer broadly as number two, and IT broadly these days as number three.
You have been in the field for over decades, but now with the advent of stuff like artificial intelligence, blockchain, the entire way of how people are betting on the market is going through sea change. Does it bother you, or do you think it's a huge advantage for those who are now foraying into the market space?
No, first of all, these new things they are not using it to get into the stock market. You may invest in an AI company, but very rarely, at least in India, we found people using artificial intelligence to invest in the market. In the world also, there might be a handful of companies who may invest in NVIDIA or some beneficiaries of AI, but broadly, they are not using AI to invest in the market yet. We have to see over time whether these models or systems can do better than fund managers. So far, we have survived well. And in other things, whether, these blockchain or you are investing in some Bitcoin or other things, those are competitors to our market. They are not our market, and I have no investment there or no faith there yet. I am interested in my market because, as I said, I have also got about a 30-year experience. And coincidentally, in these 30 years, the Indian market has been the best performing market in the world. And then if you do better than the market, you're broadly doing better than literally anybody in the world. So we have not had any need, but neither I think today is that thing for getting into the market. Somebody may separately invest, please do, but the Indian market doesn't have those opportunities, or even actually the world doesn't have so many of these opportunities yet.
Yeah. Talking of opportunities, the entire world is interested in what is happening in India. So if I am an outsider looking into the Indian market, what are my opportunities right now? And also, what are my challenges?
So the opportunities, as I said, Indian market has done well in the past, but now people are accepting it more, because if you do well when you are big, then they cannot easily ignore you. So the thing is to do it with scale. It's like saying a small cap company doing well. People say, who cares? I don't buy small caps. Now India is the fourth largest market in the world and the fifth largest economy in the world. Now when it goes up 15%, a foreign investor cannot say, I don't care, because it's a big market and he could have invested. Say 20 years, he could have said, I know you're doing well, but you're too small for my big size fund and all that. So therefore, and plus India is also getting the headlines. Plus China is doing badly these days, mostly to do with the policies that their government has taken, and also to do with some sectors which are doing badly, and real estate problems that India had in maybe 16, 15 when Jayaprakash and Unitech and all these guys had issues. The similar issues are now happening in China, but with much bigger size. So therefore, the fact that China is not doing well is also making India shine, because ultimately in funds that are investing in India, many of them are investing in emerging markets where the competitor who flows into India was China previously. Therefore, people are looking at it, the interest is very high. The challenge is that the Indian taxes for foreign investors are very high. Foreign investors, when investing in other countries, like any investor investing in some other country, basically the tax rate in that country for the foreign investor is in 100% of the other countries zero. So, for example, a US investor investing in China, US investor investing in Korea, in Taiwan, a Korean investor investing in US and UK, all are zero tax. In India, the tax rate is there's no difference between foreign and domestic investors. And that makes for foreign investors a big challenge. Therefore, over time, India has to do much better to have post tax returns similar, and that is going to be a challenge. But still, the returns are good, so even post tax are okay. But that is the only issue or a big issue.
Talking about the global geopolitical situation and also the American markets, the Goldman Sachs report has sort of reduced the risks of recession in the US. And with the election coming around, how do you think it's going to forebode for the Indian market? Do you think it's going to tell well? Because the markets have responded positively to this report as well.
So first thing is that the US interest rates they'll start cutting from September. And right now the issue is that whether good news is good or bad news is good. Because if the news is very strong about economy, about unemployment being low, about wages growth being high or retail sales being high, people say, oh my God, now the Federal Reserve may not cut interest rates. And so you don't know which one to celebrate a little bit. Because basically you want, that is why they call it Goldilocks economy, that you are not growing too fast for anybody to feel that the interest rates not be cut, and you're not growing so low, so the rate that even though interest rates might be cut, but the economy is doing badly. So right now it looks okay. And what India needs basically is not that they have to do very well, but they should not do very badly as a market. What I learned after 2008 was that we cannot say we are an island. We cannot say, oh, my company is not affected. My company does not sell to US, so it doesn't matter what is the recession there or a bad stock market there. In the end, we are all connected. Means if something becomes really bad, then we are all connected. If you're a little bit bad, little bit good, nobody cares, because these things, you can say we are independent, they are independent and stuff like that. So for now, they don't look bad, which is enough for us. There is no reason to feel negative on the US, either on economy or on interest rates or on corporate results. So broadly, they are okay, then we don't care. Beyond that, we don't care. But it should not be doing badly.
Right.
Then everybody gets connected as a financial, this thing that it's a financial investment. The foreign investors losing there. How can they invest here? Indian investor will say, rest of the world is doing badly. Why are we living in our dream? And things like that. But so far, everybody's okay. So we are also okay. We don't have to overly worry about that every day.
Right. Coming back to India again, IPOs are getting listed every day. As an investor who is seasoned and who has seen the market expand from a very small market to such a huge scope, does it excite you, or do you, sort of have a very distant objective look at how the IPO scenes are panning out? Because not everyone is going to do well, or what do you have to say?
IPOs don't excite me. Actually, previously, my thumb rule all my life was that once you have too many IPOs, that is the peak of the market. Okay, but now what has happened is that the domestic flows, which were not there in these previous episodes of bull market, are there to absorb it. But you're absolutely right. Big picture, you cannot have so many companies doing well simultaneously, because it never happens. And nowadays, another issue is that the seller is not the company. So that, they can say, okay, I'll sell 10-15%. I still own 80% of the company. And when the stock does well, I will make money. So it doesn't matter what the price of what I sell for the first 10, 15, 20%. Now the seller is mostly a financial investor, mostly a private equity fund. And the private equity fund he doesn't have anything left. He wants everything now, because he is also like the buyer. a financial investor.
Right.
And he might have 5-10%, and there might be five such private equity guys. So even when they sell the first time, they are still there wanting to sell after 3 months and 6 months. And so in many cases, this will not work, I think, but it's a bull run right now, so everything is working.
Talking about IPOs, we've over the last couple of years, we've seen the startups, taking recourse to the market for a funding route, but some of them have been received shocking response, while some have scraped through. But the market is very smart when it comes to fundamentals. Those who are trying to foray, and there are some startups which have not been able to make an entry at all despite trying multiple times. So, how important are the fundamentals of a company before it wants to foray into the markets, according to you?
No, that is the only thing that the market will look at. First of all, the startup, the market will not fund. The market will fund when that startup has some 3-4 year history at least to show that there is a path to making profit. It doesn't have to make profit on day one. Like Zomato also was not making, Paytm was not making, but they could at least show that, we are nearly there or we'll be there in 1 year, 2 years. Then the market can handle. Startup means you are on day one or first year, then the market, this is for private investors and these PE guys and venture capital guys and mostly high net worth individuals who are willing to. Stock market wants, broadly, they should be able to see that quarterly you'll have this growth, that you will not be saying that 1 quarter is up, 1 quarter is down, that kind of thing the stock market does not like. And therefore, in that sense, our ability to see the fundamentals more, because the market does not buy in the beginning. They want to see some path. Now, it may not happen, which is why these prices fall. But on day one, you can't say, I'm in a startup mode. Give me the money and let me try and work out, which is what happens when they get money in angel rounds and from venture capital, where people are betting on the individual and the big picture idea. The stock market will not have that. That's why the stock market is very good. It's much better than all these private investments that people make, even though you sometimes say the private guy who invested in one has made a lot of money. But we are talking about collectively, not talking about 100 people buying startups, one guy making a lot of money and 99 guys losing. And the guy who's losing cannot tell you a story because he's embarrassed. And the guy who made 100 times will say, see, I made 100 times. But collectively, they didn't make any money. The stock market is that broadly everybody makes, which is the market return, and then you make a little bit more.
As you know, Mr. Arora, India is becoming increasingly young, and with that, the age group which is now interested in participating in the market is, they're in their early 20s. Being a veteran, what are a couple of tips that you have for this young age group so that they put their energies where it is wanted when it comes to navigating the market space?
So first thing is that they stop overly spending their energy on the market, because they should first build their own careers. And making money in the stock market at the way it has been made in the last 3-4 years is not normal. So please don't leave your jobs thinking that because you made 25% return or 40%, it is not going to last at this rate. The stock market returns will always be in the region of 13, 15, big picture for everybody together. Of course, somebody will do much better. So therefore, first thing is to bring down your expectations. And second is, for most of them, other than somebody who turns out to be really, really astute at this, is to first concentrate on your career. Sorry for this. And separately then, invest your surplus or your time or make it as a hobby or spend 2 hours a day. I think that is important, because right now what happens is, because you as a percentage make a lot of money for the first few years because of having started in a bullish time, which is post-COVID. The overconfidence of the young I can see on Twitter, since I'm active on Twitter a lot. And that is not going to last. They will have to pay a learning fee someday. There is no way you can escape that unless you now become disciplined.
So there is no shortcut to wealth, and there is a learning fee. Thank you, Mr. Arora, for joining Republic Business on this interesting conversation.
Thank you very much.